Do you own shares of stock and you've tried to purchase puts in the past to ensure your position, but you just don't know if you're wasting money because you're buying puts and now money's just going down the tube through theta decay? Or maybe you don't know what duration to purchase or what strike to go with? Well, I'll tell you, most people buy puts incorrectly and they do it wrong. If you don't know me, I'm Sasha, the options coach. I've been teaching people to trade options over the last decade. And one of the things that we've done recently in some of the live classes that we do is the zero cost put buying strategy class. Now, this class really explored the depth behind looking at how to buy puts the right way, or also saving costs on the puts that you purchase. Now, I want to share with you a little insight as far as how people normally buy puts. So here I've got Intel, and what I've got is 300 shares. Now, if I'm looking to purchase puts and looking to get into this position, normally what a lot of people will do is they'll go out and they might buy insurance, but they might start out with something like a 7-day or a 14-day, and they'll do a short duration because obviously the puts are a bit cheaper, right? You can buy cheap puts. The problem with this is that you'll burn through the theta. So anything short duration, as you might know, burns through a lot faster theta decay or time decay, meaning those puts lose value. So when you're purchasing things, it's often wise to buy things with more time. Give yourself the gift of time. And that way you go in and you don't decay as quickly. So 35 and 42 days might be the right approach to buying puts, or even longer. So when we go into something like this, now we look at, well, where do we buy the put? Some people will again go further out from a delta perspective. We're way out here at a 10 delta, but these puts have a very limited chance of actually being used. And that's why many people lose money. So if you're actually buying a put, you could go in and get closer. Now you might say, well, now it's more pricey or more expensive. That's true, but you actually might get to use the put, and they'll actually have some value later towards the end. You don't have to wait all the way towards the end to go in and let them die. You could cash out of them a little bit sooner. But even here, let's say we're starting here with $100 a piece on the puts. What many people will do is they go in, and we've got 300 shares. They will buy all 3 contracts right there in that spot. Now, that is concentrating your risk all in one day, in one spot, at one strike, at one expiration. Whereas instead, what we could technically do is we could go in and do another put at 42 days out. We could buy one put there. We could do one put on May 2nd. We could do another put on May 16th. And we might move it to a different strike, let's say the 21. And now what we've got is 2 different puts on different days, giving me an extra week of time if I need to. And I could even do 156 days out and do another put, because I don't know when that stock's going to pull back. But what I do know is that these puts decay a different way at different expirations. So now if I go to, let's say, June, okay, yes, this one's a little more expensive, but overall my total cost is not much different. But what I am getting is some variance in the position with different strikes, different expirations, well, mostly different strikes. And then I'm getting protection at different points. And by getting those extra weeks, it allows me to defend that position on a longer term basis, meaning if the put reacts and moves against me, certain puts will react faster because they just have a faster or bigger delta, and other puts will react slower, maybe because of the time decay that happens. It also decays a little bit slower in some puts than others. So this gives me some variance to the protection. Now I still have 4 theta that's a negative working against me, and what I can do in these situations is actually go in and let's say I sell some insurance against it, meaning selling some call insurance right here. And I'll just go in and do 3 contracts right here. And what this does is level out my upside, but it drives the cost down by all of these puts. So for example, if I did 3, let's go with the same one. If I do 3 contracts on May 2nd, and then I'll go in and do 3 contracts over here. Well, if I buy, let's continue. If I buy 3 of these puts right here, okay, the cost of that is about $300. But with those $300, I can offset that cost with 3 of these for $67 a piece. That gives me $201 back, which means at the end of the day, those puts only cost me about $100 for insurance and protection, -96 in this case. And I can go in and say, okay, well, why don't I sell this one? And that means now I get back $87. And now when I have this with the stock, it limits my upside, but what it means is my puts are not costing me anything. Look at this theta now. This theta is almost zero. Whereas if I don't sell those, I'm losing $5 a day from the puts. So by selling these extra calls gives me a huge benefit and a huge cost savings on those put protections. So I'm getting something, I'm getting the insurance or the defense behind the puts, but I am having to give up a little bit of the upside, assuming that the stock doesn't explode to the moon. Now, if it does start moving, then yes, I will have to sell the shares, but overall, I'm getting a huge benefit in order to compensate for that. So anyways, this is kind of what we covered in this latest class. There's a lot more other content and material. It's a couple-day class that we had. If you have some questions about this class or material, feel free, reach out, let me know, and I'll be happy to answer some questions regarding the class or even some of the other classes that we have available. Thanks for joining me. Truly appreciate it. Hope this gave you a little insight to buying puts a more appropriate and the right way. And I will see you in the next video. Take care.